Right now, as we speak, Applied Digital Corp is trading at exactly $22.24. It is currently sliding, down 69 cents, which represents a decline of roughly 3.03% on the day. If you are watching the ticker flash red on your screen, you might feel that familiar tightening in your chest that comes with seeing an asset retrace. But I need you to pause and look past the immediate price action. While the market sees a red candle and assumes weakness, the reality is that we are witnessing a calculated consolidation in what might be the most critical infrastructure build-out of the decade. The expectation from the retail crowd, perhaps those casually glancing at the charts on their Robinhood app, is that Applied Digital is just another high-beta tech stock cooling off after a run. They see the volatility and assume instability. The reality, however, is entirely different. This price movement is largely a mechanical reaction to the massive capital structuring the company is undertaking to cement itself as a utility-grade provider for the artificial intelligence sector. The market expects a speculative crypto-adjacent play. The reality is that Applied Digital is rapidly transforming into the landlord for the most valuable computational real estate on Earth. When you look at the broader market today, the expectation is that the AI trade is becoming crowded, that the easy gains are gone. People look at NVIDIA stock or Microsoft and think they missed the bus. But here is the contrarian take that forces you to rethink your entire strategy. The bottleneck has shifted. It is no longer just about who has the chips. It is about who has the power and the cooling capacity to turn those chips on. You can have $1 billion worth of H100 GPUs, but if you do not have a facility capable of liquid cooling them and a power grid connection that can handle the load, those chips are just expensive paperweights. This is where Applied Digital lives. The drop you are seeing today, this 3% decline, is arguably noise in the face of the signal. It is likely driven by short-term profit-taking following their recent financing news, or perhaps some algorithmic selling triggered by broader sector weakness. But if you look at the institutional flows, the story changes. While the average retail trader might be selling out of fear on their SoFi Invest dashboard, the heavy hitters, the ones moving billions through interactive brokers or managing massive endowments via Fidelity Wealth Management, are looking at the asset base. They see Polaris Forge. They see gigawatts of capacity. They see 15-year leases with investment-grade hyperscalers. Let's analyze the specific intraday movement we are seeing right now. The stock opened slightly higher, but faced immediate selling pressure, pushing it down to this $22.24 level. This kind of price action is classic sell the news behavior, following their massive $2.35 billion debt offering. Investors see debt and get nervous about the balance sheet. That's the expectation. Debt equals risk. But let's challenge that. In the world of infrastructure, whether it's building bridges, power plants, or AI factories, debt is the fuel for growth. You do not build a multi-gigawatt data center campus with cash on hand. You finance it, because the future cash flows from those leases are contractually guaranteed. The market is reacting to the sticker shock of the capital raise, but the smart capital is modeling the revenue that this capital will generate. We are seeing volume today that suggests a battleground. The sellers are exiting because they wanted a quick flip. The buyers are stepping in because they understand the unit economics of high-performance computing, HPC. If you are sitting there managing your own portfolio, perhaps using tools like Schwab Intelligent Portfolios or just checking your positions on Fidelity mobile app, you have to ask yourself what you actually own. Do you own a stock, or do you own a piece of the physical backbone of the internet? Applied Digital is not a software company. It is a steel, concrete, and copper company that serves the software industry. This distinction is paramount. When you invest online, it's easy to treat every ticker symbol the same. But APLD operates in the physical world of constraints. The constraint is energy. North Dakota, where Applied Digital has concentrated its massive AI factory campuses, is one of the few places in North America with stranded energy capacity. They have effectively arbitraged the power grid. While other data center operators are waiting 5 years for a grid connection in Northern Virginia, Applied Digital is bringing megawatts online right now. This speed to market is what justifies the valuation, and it is what makes today's dip look less like a warning sign and more like an opportunity for those with a longer time horizon. Let's shift gears to the business model itself, because this is where the gap between perception and reality is widest. A few years ago, this company was known as Applied Blockchain. The expectation associated with that name was that they were just another Bitcoin miner, tethered to the volatile price of crypto assets. If Bitcoin went up, they went up. If Bitcoin crashed, they crashed. That is still the mental model many investors hold. But reality has moved on. The company rebranded to Applied Digital to reflect a total strategic pivot. They realized that the same infrastructure used for mining Bitcoin, cheap power, high density, could be upgraded to host the massive computational workloads required for generative AI. But it wasn't just a simple switch. You can't just plug an NVIDIA H100 into a slot designed for an ASIC miner. It requires different cooling, different redundancy, and different networking. Applied Digital spent the capital, hence the debt, to build these next-generation facilities. They are now offering GPU as a service and pure co-location for hyperscalers. This means they are leasing space to the biggest tech companies in the world. When you look at your screen and see $22.24, you are looking at the price of a utility company for the AI age. The recent news concerning their partnership with Macquarie Asset Management is a critical piece of this puzzle. Macquarie is not a retail trader speculating on a meme stock. They are one of the world's largest infrastructure investors. They build toll roads, airports, and power grids. The fact that they are deploying nearly $1 billion into Applied Digital's operating subsidiaries validates the thesis that data centers are the new infrastructure. This is smart capital entering the room. When you see a 3% drop on the retail market, but you know that a global infrastructure giant is backing the project, you have to weigh who has the better information. Is it the day trader on the Robinhood app panicking over a red candle? Or is it the firm with a team of analysts who toured the facility in North Dakota? This disconnect is where your edge lies. We must also discuss the technology of cooling, which sounds boring, but is actually the single most important factor in this stock's future. Traditional data centers use air conditioning. They blow cold air over hot servers. That works fine for hosting a website or your email. It does not work for a cluster of thousands of AI chips running at full utilization training a large language model. Those chips get so hot they would melt in a traditional server rack. Applied Digital utilizes advanced liquid-to-chip cooling technologies. They are building the facilities that can handle the heat density of the future. This is a defensive moat. A competitor cannot just decide to compete with them. They have to retrofit their entire building, which is often impossible, or build a new one, which takes years. Applied Digital is ready now. This creates a scarcity value for their assets. In a world where every company from Tesla to Meta is trying to secure compute capacity, the landlord with the cool, powered-up space holds all the cards. I want to take a moment to hear from you. Comment below how many shares of Applied Digital you currently hold, or if you are waiting for a lower entry point. Are you watching this $22 level as a floor, or do you think we revisit the teens? And also, let me know if you use a platform like SoFi Invest, or if you are trading through a traditional Fidelity brokerage account. It is always interesting to see where the retail flow is coming from. Now, let's look at the risks, because an honest analysis must acknowledge them. The expectation is that AI demand is infinite. The reality is that it's cyclical. If the hyperscalers slow down their spending, or if a new, more efficient chip reduces the need for power, Applied Digital could find itself with expensive, empty buildings. Furthermore, that debt load we discussed, it's real. Interest payments are a real cash outflow. If they can't execute on leasing these facilities quickly enough, the leverage could bite them. This is why the stock is volatile. It's a high-stakes execution play. They have to finish the construction, they have to get the power turned on, and they have to sign the leases. The recent deal for the Polaris Forge 2 campus, anchored by a US-based investment-grade hyperscaler, de-risks this significantly. But execution risk always remains. However, consider the macro environment.